This is FRM Part 2, Book 2, Credit Risk Measurement and Management, and the chapter on spread risk and default intensity models. Default intensity really just meaning default timing. Intensity is a good word to be described and used in this chapter title because this is an intense chapter. I'm guessing there are many of you who like to read the chapter before watching the videos, and I congratulate you on getting through that chapter. Those of you who like to watch the videos beforehand and then read the chapter, good luck. Let me show you what I mean by that. Let's look at these learning objectives. We have a whole range of action words here, but I'm going to break it down into kind of two really important topics throughout these learning objectives. We're going to talk about this default intensity, and we're going to call it a hazard rate. And in the beginning, we're going to assume some kind of a hazard rate, and then we're going to try to compute that hazard rate. And in the meantime, we'll have to talk about different types of distributions. We'll have to start out with just a simple discussion on bond pricing and spreads, and then we'll get into really fascinating stuff in the credit default swap market. Well, let's go ahead and start with something simple, bond yields. Boy, we learned this all the way back in the beginning chapters, and I'm guessing most of you learned this back in your undergraduate days. You know, the yield. I always tell my students, think of the yield as the required return on a bond. And so this yield, let's call it a yield to maturity, and we'll talk about some other yields throughout this chapter. But if you buy a bond today and its yield to maturity is 10%, and you A, receive all the promised coupon payments, and B, you hold the bond until it matures, and then C, the issuer pays you the par value of the bond, then you will actually have earned that yield to maturity. Here's a quick slide on the history of Aaa-rated bonds. And so you go back to a long, long time ago when the yields were, what does that look like? 5% and 2.5%. And then notice this gigantic run up during the 60s and 70s. We had the oil price spike. And then, we had high yields during the early 1980s, during the early Ronald Reagan years when mortgage interest rates were, 16 or 18%. And then we've had a downslope since 1980, which can be attributed, I guess, at least partially to a growing economy in general. And of course, we can lay some of that at the foot of the Fed and their expansion of their monetary policies there. By the way, another piece of probably not totally worthless information that I share with you guys regularly, but as of 2020, there are only two AAA-rated bonds trading in the United States, Microsoft and Johnson & Johnson. So I'm not quite sure what those squiggly lines there over on the bottom right mean. That's really just a small sample. But anyway, it gives us an idea so that we can go right into this concept of a credit spread. And so a spread is, of course, what the name suggests, just the difference between two numbers, right? And here we're going to take the difference between two yields on bonds. So notice in this little graph we have the black lines are the yield on higher risk bonds, and the blue is the yield on treasury securities. And so, you look at that, can I do it like this? You have a pretty, I don't want to say fixed, but, pretty standardized spread. And then sometimes it gets wider and sometimes it gets narrower. And then, of course, we have this gigantic spike. And then, what are those spreads? Maybe 3%, maybe 5%. So that's pretty much a historical sense of what credit spreads in general look like. Now, what we've been talking about here is just simply the yield spread. So this is the difference between the yield to maturity on a credit risky bond and the yield on treasuries. And of course, we'd like to use the on-the-run treasuries, but we don't have the Treasury Department, even though in 2020 the Treasury Department seems like they're issuing bonds and bills and notes almost every day. They're probably not, maybe 3 times a week. So they're not on-the-run treasuries, and so you have to get these other ways and off-the-run treasuries so that we can make some kind of an interpolation or an estimation. So notice what I have there in that just simple equation. Yield spread is the yield to maturity on a risky bond and the yield to maturity on a default risk-free government bond. So I remember my professors would just use the shortened term risk-free bond. And I remember thinking to myself, you can still buy a treasury bond and lose money if you have to sell it beforehand. And that's the difference between interest rate risk and default risk. So let's make sure you understand this is yield to maturity on a default risk free government bond, but it still has interest rate risk. Now, that yield spread is, of course, just the simplest of all. And anybody, even a kindergartner, can take 10% and subtract 6% and get 4%. But there are other measures out there that are important, and in fact, perhaps even more important as we move through this discussion. Let's go ahead and talk about this interpolated spread, or the I spread. That's the difference between the yield to maturity on our credit risky bond and the linearly interpolated spread. And it has to be linearly interpolated because there's not an exact bond. I mean, when we go up to that yield spread, we might say, okay, we have a 10-year Johnson & Johnson bond and we have a 10-year Treasury bond, and they both mature on the same day. Well, then you can subtract those two. But suppose that we have an 8-year bond and a 9-year bond and a 10-year bond, and we're trying to figure that out. So that's what we do with the I spread. And so let me give you just a quick example here. So here's a 10% bond with a 10% coupon with a yield to maturity of 10.49%, and then a treasury has 6.69% yield to maturity. Let's just assume the yield curve is flat just to make our life simple. And there we have our yield spread of 380 basis points. But suppose this our bond, this ABC bond, has a maturity date of 9 years, and there is no treasury security that matures in 9 years. So we need to interpolate. So there is a 10-year treasury bond and there is an 8-year treasury bond, and so we just kind of take the difference between those two. Now look at the blue equation down there towards the bottom. Notice we're dividing by 4, even though 10 minus 8 is 2, and that's probably because these bonds pay interest semi-annually, so there are 4 compounding periods or 4 payments in between 8 and 10. So make sure you divide by 4 to get the 6.08% I spread. That should be pretty straightforward math. Now, we use the I spread as an estimate, you ready? As an estimate of the yield spread, right? We're interpolating. But there are some other complicating factors with bonds. And remember when we had our discussion with bond pricing, if we use that yield to maturity as one of our inputs to determine the bond price, it's really just a very simple model. We're assuming that the yield to maturity remains constant over the life of the bond, 5 or 10 or 20 years or even 50 years. And that's a completely unrealistic kind of an assumption. So what we did then is that we broke the bond into its little component parts of cash flows, assuming there were 0 coupon bonds and 0 coupon bonds and 0 coupon bonds, so that each coupon payment was in and of itself a 0 coupon bond, and then we were able to use spot rates to compute the price of the bond. Now, of course, we did spot rates. Those were treasuries, so that then we computed the price of a treasury. But now we have a credit risky bond. How do we use that kind of a concept to estimate spread? And that's what the z-spread is. And so I want you to first look at the graph over there. Here's our benchmark yield curve, and then we have our risky yield curve. And that z-spread is going to be a unique spread over the term structure that forces the present value of those coupon payments and the principal payment, which is to the right of the equal sign. It forces those present values to be equal to the bond price. Now, in the light blue box, I show you what this z-spread looks like using discrete compounding. So we have a bond price over there to the left of the equal sign. Suppose that's 97 or something. And then we have our cash flows. So the coupons, maybe they're $5 for 5 years or 10 years. And then at the end we have $105. So we're going to discount that at 1 plus the spot rate for time period 1 and time period 2, right? So that spot rate is going to be unique for each of those 0 coupon bonds or each of those coupon payments. And then we're going to add some basis points to each of those 1 plus the spot rates. So note, we know the bond price, we know each of those cash flows in the numerator, we know each of those 1 plus the spot rates in the denominator, and then all we're going to do is solve for that z number of basis points. And that's what the z-spread is with discrete compounding, which is not used in your textbook. The continuous compounding formula in the dark blue box is exactly the same thing. So dark blue is continuous compounding, where we have to do e raised to the minus x, so to speak. Remember when we take present values. So that's all we're doing, taking present values. So I give you the light blue box, to give you the kind of the obvious notion of what we're trying to do with the z-spread, and then we just convert it to continuous compounding. And then the chapter does have a minimal discussion on some other spread measures, and I would just know those definitions there. And I'm guessing that you probably do from previous discussions. Now remember, in an earlier chapter, we had a discussion on owning a bond and being concerned about interest rate risk. This is different than default risk, which is what we've just been talking about. Interest rate risk, of course, means that when interest rates go up, bond prices go down. And so what we need to do is we need to put together a big old Excel spreadsheet so that we have our current yield to maturity on the bond, and then we kind of go up by 1 basis point or 10 basis points or whatever that is, and then we go down, and so then we can get the whole spectrum of possible future bond prices for interest rate changes. And so you might remember we talked about duration and we talked about convexity, and we called that the DV01s. Well, of course we can extend that thought process, extend that procedure to spreads, right? So in the first case with the DV01, we're saying what happens if yields go up by a little bit or down by a little bit. Now we're asking the question, what happens if spreads, which are, let's say they're this amount, what if they go up? What if they go down? So we're going to call this the DVS1, the change in the value of a credit risky bond for a 1 basis point change in spread. So now remember, I'll do this again. So spreads can increase for 2 reasons. Either the yield on our bond, here, that's my pointer finger, the yield on our bond goes up, or the yield on the, it's hard for me to do that, the yield on the treasury or the benchmark goes down, right? Or both rise, but our bond yield rises by more, or both fall and the treasury or the benchmark yield falls by less. So you have a bunch of different ways in which the spread can change. Now, that's much more dynamic than just, yield goes up by 1 basis point or yield goes down by 1 basis point. Let me show you what I mean by this. Here's a little graph. So let's suppose that we have a bond that's in the red circle and then a bond that's in the orange circle. So what is that? Around a spread of 201 basis points for the red and 204.5 basis points for the orange. So all we kind of do is say, hey, let's suppose that the spread falls by 1 basis point or a half a basis point and goes up by a half a basis point. So the increment is 1 basis point for both of those. And then we can go over on the left-hand column and see what happens to our bond price. So note at, at lower basis points, at lower Z spreads, we have a change in the bond price of 20 cents, right? 92.45 and 92.25. But at higher Z spreads, we have a different change in the bond price, 92.15 down to 92. So this is important. So this the spread zero ones exhibit convexity, which means that an increase or a decrease in the spread has a much smaller impact when that Z spread is higher than when it's lower. All right, so that's pretty much the first part of the chapter, and that's introductory, and those slides should be relatively straightforward for you guys. So now we're going to get into the second part of the title chapter with that word intensity. So let's ramp up our awareness in our brain cavity and see if we can't make some sense of all of this stuff. I bet you remember, and I probably talked about this in a previous video, that Bernoulli trial. You flip a coin and what can happen, right? There's only two things that can happen, heads or tails. Unless, of course, that you're a Pittsburgh Steelers fan and Jerome Bettis, you guys remember in a playoff game, Jerome called some heads or tails and it fell on the ground and the ref said it's tails and Jerome said, no, I called heads or whatever that was. There's a good video for you guys to look up. Anyway, but so clearly in the absence of NFL controversy, you can either have heads or tails. So how this relates to our discussion here, you can either have a default or a non-default. And so that Bernoulli trial is default or non-default, right? And then it's over. But when you're sitting around and you're flipping a coin, you can't do it just one time. So you flip it again, and then you flip it, and you flip it. So that's when the Bernoulli trials turn into a binomial distribution. And so that makes much more sense for us in considering default or no default, because what we want to do is we want to see, are we going to default this year on this particular bond? Then are we going to default next year? Then. So we need this binomial distribution. And so a couple of chapters ago, we defined success with the notation of pi, and then failure as 1 minus pi. So there's a 1 and a 0. And we need to always specify the time period. Maybe 1 year, maybe 2 years, maybe 5 years. And so this is important that we're having a discussion on a discrete number of periods. So look at the bottom and let's go ahead and identify what this question really means, right? If we set the probability of default equal to 5%, then we can use this whole binomial distribution by determining the probability of survival over the next decade using that pi of, what did we say, 5%. So if you do the quick math, you get around 60%. Now, before I move on, let me go ahead and say a few words about this and how it relates to bond defaults. We can pick that time period. In this case, we picked 10 years, but we could pick 20 years, or we could pick 30 years, or 50 years. But some more interesting questions might be, what happens if we want to go in the other direction? Suppose that we want to know about the probability of default for 6 months, or 3 months, or 1 month, or 2 weeks. And of course, during the 2020 COVID issue, There are lots of small businesses that are in danger of defaulting. And so to ask the question, what's the probability of survival over the next decade, is probably not nearly as relevant as, how about the probability of survival over the next 2-week period when economies are shut down? Now that's what brings us to some other kind of a distribution. Let's call this the Poisson distribution. And really what we're interested here is defining the number of defaults over a specified time period. All right, so think about what we did back here. We were looking at one specific bond over a 10-year period. But what do we know? We know as good investors and as good financial risk managers that investors are going to hold well-diversified equity portfolios and well-diversified bond portfolios. So let's forget about the equity portfolios here, and let's talk about the fixed income portfolio. What if we have 100 bonds in our fixed income portfolio? Can we go back here and ask the question, what is the probability that all 100 of these firms are going to survive over a decade? Well, we clearly can't use that formula down at the bottom, but what we can do is we can use a distribution of those 100s, and that's going to be this Poisson distribution. So look at the bottom there. We want to know what is the probability. What is the probability over some kind of an interval, some kind of an n interval with some kind of a, boy, can I call that lambda a hazard rate just yet? Some kind of rate, some kind of a rate here. And so there's that Poisson distribution function. It has a mean, lambda of 1 over those number of defaults. Now, so what we can do, before I move on, what we can do with the Poisson distribution is that we can ask that question, number of defaults over a specified time period, like a year or 6 months or 3 months or 1 month or 2 weeks, right? But what if we have a problem in which we're trying to determine a default over a time period that's really, really tiny? During this early 2020, I keep reading about women who are giving birth when they don't quite make it to the hospital because of the hospital beds. They're not quite sure if they have any hospital beds. I read this morning of a woman that gave birth during a high-speed chase. I didn't even read the article, but I don't know what that meant. So you think about a hospital has these beds for COVID-19 patients, but they still need to have beds for women delivering babies. And so this is a really, really good question of, boy, are we going to have a bed over the next 1 minute when 100 women show up that are in labor? Well, back to my example about these small businesses, are these bonds going to default if the government bailouts are not going to be helpful? So that's why we need the exponential distribution. And so that's what happens here. So the exponential distribution is helps us answer the question about how much time elapses until a specific event occurs. When is the next woman going to show up to deliver a baby? When is the next default going to occur? And so you need a continuous distribution function to be able to answer that question rather than a discrete distribution to answer the Poisson distribution question. Now, I will say this. Those of you who looked at the chapter, man, there is just a paragraph or two on the Poisson distribution. But then the remainder of the chapter is based on exponential distributions. All right, so there's the probability density function in blue in the middle. And so there's that historical average of mu. And so this lambda is going to be our rate. I said a rate just a few moments ago. It's the rate at which it will take for an event to occur, right? The delivery of the arrival of another woman or a default. So look at the circle point there inside the block. This is equivalent to the hazard rate. So lambda is our hazard rate, which indicates the rate at which a default will arrive. So during periods of tremendous economic growth and financial institutions are finding lots and lots of positive net present value projects, then that hazard rate is probably going to be relatively small. But during the financial crisis that began in 2007 or 2008, and during the COVID-19 crisis that occurred in early 2020, well, that hazard rate has to increase, right? Here's a good summary table on the difference between those, and I think I've highlighted this. So Poisson number of defaults over a particular period, exponential time interval between two defaults, discrete versus continuous distribution. And so note the final block point there, our focus is mostly on the exponential distribution. In fact, after that one mention of Poisson in a paragraph, it's not mentioned again. All right, so let's go ahead and focus on the hazard rate. So what did I say in the introduction here? We have, kind of two parts of this slide deck and the chapter. We've got the spread part, which we've done most of. Now we're going to swing back at the end and pick that up. And now we have this intensity, right? Default intensity. And we're going to call that the hazard rate, represented by the parameter lambda. And so what we want to know is what is that probability of default over the next really, really small time interval. So that's where I have lambda times dt, that change in time, and that change in time is a small interval. I mean, it might not be a second, it might not be a minute, but it might be a day. Now, if we extend that to longer time periods, now remember, we're in a continuous function and a continuous mindset. And so we're always interested in cumulative probabilities of default and survival. And then, of course, so the cumulative probability, I always picture this in my brain as a bell-shaped curve. So, you start over there on the left, with really, really tiny probabilities, and then you work your way up, so those cumulative probabilities. But then the marginal probability is that next slice. What is that next slice? Let me show you a quick example here. And this will satisfy one of those compute or calculate learning objectives. All right, look in the red there in the middle. We have a scenario under which we have a hazard rate, or a lambda, of 0.1. So there's our rate, 10%. So we're going to go back and use these. Let me just go back really quickly here. We're going to use these cumulative probability functions there. And so let's go ahead. Down the left-hand column, we have time is today. So then it's 1, 2, and 3 years from today. And let's skip over the first column. Let's go right into the second column, the cumulative probability of survival. Just because I want to equate it back to something that you've done for a really, really long time. So this is just like discounting. Remember when we have e raised to the minus something, we're discounting it. So this is kind of like, it's not identical because the hazard rate and the interest rate are not identical, but it's kind of like taking a present value. So, if you start with 100% cumulative probability of survival, 90, then 81, and 74. So this makes perfect sense. And then the cumulative probability of default is just, the other side of the graph. So let's go ahead and look at that first column. So we have a cumulative probability of default in that first year of 9.52%. Which is, of course, the probability of default during that first year. It's both the first one and the cumulative probability. So 1 minus that has to be 90.48%. And then you can repeat the math as you go down in years 2 and 3. So for an exam question, I would be able to calculate the the 952, the 1813, the 2592, and then the one minus those, right? And then the probability of default for that particular year, 9.52, 8.61, and 7.79. Of course, the 8.61 in year 2 is just the difference between the cumulative probability in year 2 and the cumulative probability in year 1, which is like a marginal probability of default in that second year and in that third year. Notice that those fall. But then that conditional probability of survival until that time period, I'd be able to calculate that. So those are relatively simple calculations. Should be okay. Now the chapter has two, what I think are pretty interesting graphs, but they might be just a little misleading the way they're drawn. And so I want to call your attention to both of the axes. So look on the horizontal axis, where we have time from 0, which is today, right? Then 5, 10, 15, 20. And I want you to imagine a 30 and a 40 and a 50 out there. So there's our cumulative probability of default going from 0% all the way up to 100%. And so note that cumulative probability is increasing, and it's increasing at a decreasing rate. Is that the way you say that? But then once you get way out to time period 20 and 25 and 30, notice that it flattens off. And I'm fascinated by what happens out there at 50 and 60 and 70 years. And to illustrate that, notice that it just doesn't ever quite get to 100%. Which means that not every bond is guaranteed to default. I mean, it approaches it. That's why we do probability limits with these continuous functions. But look at the example of Lehman Brothers. Lehman Brothers was created. This firm was created by these two brothers who came to the United States in, 1830 or 1840 or 1850. And they came to Alabama, and I think they were farmers, and they sold stuff to farmers, and they sold stuff to manufacturers. And, after a while, they got into, I think, the cotton industry, and then they went to the New York Stock Exchange, in 1870 or 1880. So you think about this, Lehman Brothers, you would think this company would be around for a really, really, really long time. So that's, I don't know, what is that, 140 years, 150 years? But sooner or later, what happened in 2008? They no longer existed. And so, I think that's interesting. Does that cumulative default probability ever get to 100%? And the answer is probably yes. But for exam purposes, I don't know. Maybe yes, maybe no. And then here's the second one. So the hazard rate, in terms of, this is an example of a constant hazard rate. So marginal default probabilities, right, they continue to fall, but it never gets to 0. Does it ever get to 0? I don't know. Ask Henry Lehman or Harry Lehman, whatever his name was, back in 1840. All right, so let's go ahead and link the concept of the spreads that we talked about originally and the lambda, this hazard rate. All right, so look in the middle of the page. There's a good old formula. Average, this is average. Average default intensity over the life of the bond is equal to the spread over 1 minus the recovery rate. And if you look at the bottom of the slide deck, there's just a quick example of coming up with a hazard rate of, around 3 1/3%. All right. These are risk neutral probabilities, and note that this is extracted from the market price, right? So that S in the numerator, that's the spread of our bond, our credit risky bond, over some kind of a treasury or some benchmark bond. So that spread is determined by market prices. That's the value here. And that's relatively simple. But the next question is there a more complex way to do this, or maybe a more accurate way to do this? And the answer to that question is, of course, yes. And we turn to this credit default swap market because The credit default swap market is about this big. Can you even see my hands? I mean, this is one of those amazing things. I remember being an undergraduate student, and one of my professors said, just one day, it was kind of an offhand remark. He said, there are more mutual funds than there are publicly held corporations out there. And I scratched my head and I thought, man, that's really fascinating stuff. But look at the bottom there. The CDS market, a couple years ago was, I don't know, 3.5 trillion, 4 trillion. I mean, I can't even wrap my arms around what multiple trillions of dollars looks like and what it means. And so this credit default swap market, they have standardized contracts and they're issued on a wide range of reference entities, not just corporate bonds, but municipal bonds and sovereign bonds and all different sorts of bonds. So we have this gigantic market. Why don't we use it? Because the price of a credit default swap is probably much more accurate and much more relevant than maybe a ratings agency AAA rating on a particular bond, which tends to look at history rather than the future. And so, look at the bottom there. These credit default swaps, this market is way more liquid than the bond market. So the question then is, back here, we can use some simple model, right? But this simple model is going to give us an average default intensity, an average lambda over some bond lifetime, like 5 years or 10 years or 40 years. But how about if we can draw some type of a curve? Oh my gosh, we know how valuable, the par curve and the spot curve and even the regular old yield curve is. We know how valuable those things are in helping us price bonds. Well, so some other kind of a curve has to be helpful in providing us with extra information about default risk and default intensity. All right, so what do we know? What do we know about credit default swaps? And so these are great conversations. I love having these with my students. In fact, I teach credit default swaps in almost every one of my class because A, it's relevant, and B, it's pretty interesting. And for me, it's pretty exciting. And so, you think about this. You have a bond. Let's just suppose it's a Johnson & Johnson bond, and Johnson & Johnson promises to pay us $100 in 5 years. That's the maturity value of the bond. And, for some reason, we're thinking, boy, over the next 5 years, maybe people are going to stop, buying Q-tips or buying shampoo or getting hip replacements or all the stuff that Johnson. And so we're concerned about receiving that $100. But we know Johnson & Johnson is a AAA rated bond. And so we might think to ourselves, let's go ahead and buy some insurance. So let's pick up the phone and call a financial institution and say, hey, how about if I pay you regular amounts, will you pay me that $100 on the maturity date of this bond if I don't get it from Johnson & Johnson? And of course, financial institutions, this is what they do. This is their business. They're not going to turn us away. They're going to say, yes, of course. But let's figure out what that price is. So notice these block points here. At initiation, neither one of us exchange any cash flows, right? But we have to agree on a set of future cash flows. So there's the fee leg. How much am I going to pay you as insurance? Now, if that Johnson & Johnson bond matures for $100 and I'm going to pay you, now, of course, they're quarterly here, but let's just suppose I pay you every year. I'm not going to be willing to pay you $20 a year for 5 years, right? 20 times 5 is 100. That's way too much. Am I going to be willing to pay you $5 a year? That's probably too much. I might be willing to pay you a quarter every year because it's a AAA rated bond. All right, so how we determine that fee leg, how we determine that payment is going to go a long way to tell us about the riskiness, the default riskiness, the intensity of that uncertainty of the $100 payment made by Johnson & Johnson in 5 years. Now, the financial institution, all it has to do is promise to pay me $100 if I don't get it from Johnson & Johnson. So the price of that credit default swap has to have a net present value of 0, or neither one of us would enter the transaction. All right, so here's this cool thing. How can we derive a hazard rate curve from that CDS spread? All right. Now notice the second block point. Let's suppose we have only a single CDS spread for a firm for a term of 5 years. All right, the protection buyer is going to do this in quarterly installments. So T is a quarter of a year and a half a year and 3/4 of a year and so on. And there's our probability of default from the exponential distribution that I had up on a previous slide. All right, and that bottom block point is really important. The CDS valuation must force the present value of the fee leg to be equal to the present value of the contingent leg. All right, let's work through an example, and this is the big example that's inside of the chapter, and these are the exact numbers here. All right, so we have a credit default swap. The protection buyer is going to pay a spread in quarterly installments, if and only if, right, that the bond is still alive on that payment date. So there's our probability of survival and the probability of default. There's our pi from earlier. And we're going to make the assumption that defaults can only occur halfway through the year, and that 1/2 of that quarterly premium would be payable. So we've got some accrueness. Accrueness, is that a word? We have some accrueness going on because of this 1/2 convention. And this is really a simplification. I mean, if you can allow default to occur at any instant during that time period, it gets way too messy. All right, so here's what I perceive to be the big formula inside of this chapter. Notice I have one in blue and one in red. And so what did I say in the bottom of that? Here, let me go back there. The last block point. Present value of the fee leg has to be equal to the present value of the contingent leg, and that's what I have in the last block point. So blue is the payment leg, and red is the contingent leg. All right, so let's start, and I want to do this in very general terms. Let's start with the red contingent leg. Now that P in there, that's the par value of the bond. So what we need to do is take the present value of the par value of the bond. So let's just suppose that it's 100. Just like I said with the Johnson & Johnson. So the financial institution is going to pay me 100. All right, so I have to take the present value. And notice there's a 1 minus R out there. Let's just forget about any recovery. Let's just suppose Johnson & Johnson ceases to exist, and for some crazy reason its assets are worth $0. So if we take the present value of that $100, and let's just throw in some kind of a rate of 10%. So if you do the math there, over this time period, maybe you'll get $60, right? All right, so the red is going to be $60. So let's go up and look at the blue. So how are we going to force those payments to be, the present value of those payments to be, what did I say, $60? So if this is a 4-year bond, if this is a 4-year CDS, then those payments will be like $16 or $17, right? If it's a 5-year CDS, then those payments will be, I don't know, $12 or $13. I'm rounding, just using a rate of about 10%. So you see that we've got an ordinary annuity of, let's say $13, and then we have a lump sum. So those present values have to be $60, right? All right, so let's go ahead and break both of these down. And boy, I spent a lot of time on this, and the AnalystPrep team spent a lot of time on this, trying to simplify this because it's a little complex in the chapter. All right, so here we are with this fee leg, right? So we're taking the present value, so we're summing And this is 4 because we're doing it 4 times a year, right? Quarterly payments. So that 4 there over on the left-hand denominator converts that time back into the years. So S is the spread. And then, of course, remember with a credit default swap, there's no notional principal exchanged at initiation and maybe ever if somebody sells the CDS during its life. So what we need to do is we need to take those spreads in terms of basis points and then convert them back to the notional. And so that was just given in the textbook as the notional in there. All right, so let's go inside of the brackets then. We have a probability of survival. There's 1 minus the pi. And then we have, in the next brackets, we have the probability of default during that particular quarter, right? We're summing from the mu1 all the way up to 4 times time, right, for those quarters. So mu, the difference between mu and mu minus 1, right? And there's the 1/2 because of our notion of, those defaults can only happen at 1/2 of the year. And then we're taking the present value of all of those. All right, so let's go through the notes here. There will be no default and the contract will be in force at the end of the quarter, right? There will be a default event, which we assume occurs in the middle. So we've got to take 1/2 of that quarterly spread and accrue that to the premium. And then the expected present value of the payment leg must take into account both of those note probabilities, right? How did we start all this? We started this with the Bernoulli trial of flipping the coin, right? Heads or tails, default or no default. So we started that process. And so this model here and using this exponential distribution has to consider, both of those possibilities. You see how more complex it is than just flipping a coin. You get heads or tails. Now, the contingent fee leg, this is a little bit more simple than what we just did in the blue. Notice we've got that 1 minus R out there. So maybe Johnson & Johnson can sell its assets and recover 40%. And that seems to be like a standard rate in some of these chapters. I think 40% recovery rate has been used in multiple examples. And so that's all we're doing here, considering the recovery rate and then considering the present value of this contingent leg for each successive quarter. All right, so the blue, let me go back here. The blue has to be equal to the red. And now we can go ahead and do some math in an example. So going ahead and doing all of the substitutions that we just talked about, we get this formula here. There's still an equal sign there, so we still have the blue and we still have the red. And now we're going to substitute so that we can come up with a value of lambda. So remember in that previous example, we were just assuming a lambda, what was that, 10% and then maybe 15% in one of those graphs. Now what we're doing is we're going to try to use we're just using our bond pricing model, our present value bond pricing model applied to credit default swaps to solve for the hazard rate. So look at this equation. So there are a bunch of lambdas in there, and we're solving for those lambdas. Now here's the exact example taken right out of the chapter from Merrill Lynch back in 2008. There's a spread for 45 basis points, and we have some other information that's given to us. There's our blue, and there's our red. So solving this equation, solving for lambda, gives us about 7.5% hazard rate. Now, when I first saw this, and by the way, the chapter just gives it exactly like this, solving gives lambda. So I was scratching my head and I thought, you know what, if I had to do this, how would I solve for lambda? And I didn't really have a good answer. So thank heavens for computers and algorithmers so that they can come up with an easy computing solution to this. And I'm sure it's easy, but I clearly don't have the technical skills to do it. But the good news for you guys is that you probably are not going to have to do that on an exam. Now, what did we come up with? We came up with this lambda, this single hazard rate over the 5-year credit default swap life. But what if we wanted to come up with a curve? What if we wanted to derive a hazard rate curve? And this is where the chapter goes into painstakingly detail to show you this bootstrapping process. And hopefully you remember bootstrapping when we did, what did we do bootstrapping on in a previous slide deck? We did it for those interest rate trees when we were computing the price of a callable bond. We did it with some other kind of an interest rate curve to try to, interest rate tree to try to get some of those interest rates. So bootstrapping is relatively interesting, and it's a great process for us to kind of fill in the blanks. And that's what the chapter does here. And I'm just going to go ahead and summarize, 3 or 4 pages inside of the chapter. Notice we're solving for lambda in year 1 and year 3 and year 5 and year 7 and year 10. The I over there, those are the intervals that we're trying to compute. So notice we are estimating this hazard rate curve from the 9.6 over that 1-year period all the way to, 3.5%, all the way at 10-year period. So the estimated hazard rate curve is downward sloping. Of course, that makes perfect sense. And we did this through the use of bootstrapping. So what we really do is just repeat this process. So we're forcing the blue to be equal to the red. Are you ready for this? Over these different intervals, interval 1 and 2 and 3 and 4 and 5. Now, I found the curves inside of the chapter less than obvious notions with the way they were drawn in answering this question. So we drew these curves just a little bit differently than you see them in the chapter. So here's the question then. What happens when the spread curve has different slopes? In other words, where are these distributions falling? If we have spreads that are narrowing or spreads that are widening. All right, so let's start with a downward sloping spread curve. What does that mean? So we have, let's just take one bond issue that has, let's say, 500 basis points in year 1, and then those fall. They become more narrow. All right, so the spread is expected to narrow over time. So if you graph that, that's a downward sloping spread curve. Now, what does that mean for a hazard curve? Well, that means what the market is doing is assigning a much higher probability of near-term default, right? So that's why we have this steep slope. So here's a high-risk firm that is exposed to lots of risk early on, but if this firm can make it through those tough times, then it flattens out. All right, so let me go ahead and read this to you. Downward sloping curve, synonymous with a default distribution that is steep for shorter horizons because this is the danger zone, right? And then it flattens out because if it can make it through that difficult time, then it's probably more efficient and more prepared and more skilled and has more experience so that it ought to be able to make it through anything that occurs farther out. Now, of course, kind of just the opposite happens with an upward sloping. All right, so if we start with in year 1 and 2, say 200 basis points, and then over time we increase to 400 and 500 and 600 basis points, then we have an upward sloping spread curve. So what does that mean? That means that the market has said, you know what, this firm is pretty strong now, but there's enough uncertainty in the future that it might have an increase in the probability of default. So there's flat there, and then it's steeper as we go through time. your chapter then has a relatively short paragraph on some kind of practical ideas about spread curves. Spread curves are typically gently upward sloping. Gently upward sloping. All right, so just think about the spread curve means that over time, that the market assigns higher spreads because of, look what I have in bold, unforeseen and unforeseeable change in the firm's situation, either at the micro level inside of the firm or at the macro level outside of the firm for the entire economy. Downward sloping spread curves are quite unusual. But of course, subprime mortgage crisis, yeah. Now let's go ahead and relate that those narrowing or the widening spreads to our credit default swap. Now remember, I don't think we agreed on a price. So if I get a financial institution to agree to pay me $100 if Johnson & Johnson bond defaults, I may agree to pay the financial institution, let's say $2.50 a quarter. That might even be a lot, but let's just go along with that. $2.50 every quarter. Yeah, that's too high. Let's say $1 a quarter. So $1 each quarter. All right. So then what happens over time if the spread on that Johnson & Johnson bond narrows or widens? Now, if the spread narrows, that probably means that there's less risk on this assigned to this Johnson & Johnson bond than when I entered this credit default swap. So I'm suffering, right? I'm paying too much. In my $1, I'm paying too much because now the probability that Johnson & Johnson default is going to be lower as reflected by those narrowing spreads. And of course, if spreads widen, then we just have the opposite. So suppose the spread goes like this, and I'm only paying $1. And let's suppose that Johnson & Johnson stops making Q-tips and all that stuff, and their cash flows go from this all the way down to this. Remember, I'm only paying $1. When new investors into the CDS market, they might have to pay $5 or $10 or some big number. Now, of course, in the credit default swap market, what we could do is we could just require that mark-to-market occurs every day, like on the organized futures exchanges. So we could force marking to market every day, but nobody in the over-the-counter market wants to do that. But what we can do is we can pretend that we can mark to market. So this is how we're going to measure spread risk. We can do a shock like we did with the spread 0-1s, and we can put together a spreadsheet. And we can say, okay, if the spread widens or it becomes more narrow, this is what happens. And so we can see this on a daily basis. That's one way to measure spread risk, pretending that we're being forced to market, right? Now, we can also use standard deviation and the introductory stuff that we learned back in our first stats course. We can use standard deviation and compute a confidence interval, and we can do this in basis points per day. So we can do this two ways. We can do it using current market prices and then kind of shock them up and down to see potential prices. And remember, these models are sophisticated enough that when we have, just a really small basis point change, we can probably get pretty close to what that CDS price would be tomorrow, right? Or we can use a measure of volatility, maybe historical standard deviation, maybe some expected standard deviation, to try to do the same thing in a confidence interval environment. Oh boy, do you agree with me that that was intense? So we covered all of those learning objectives. Two things here, two takeaways. The spreads, but not just the regular spread stuff that we talked about at the beginning of this slide deck, but how those spreads can help us in our credit default swap using the exponential distribution and all that stuff we talked about in the middle. So thanks for paying attention to this one. Go read the chapter.